Welcome to International Trade, ECO735 in the second semester of 2021. My name is Federico Foders. I'm an extraordinary professor in the economics department of the University of the Western Cape. What we will do here today is to take a look at the introduction to this lecture. We'll discuss some world trade forecasts presented by the World Trade Organization, the WTO. We will take a look at South African trade, what happens in South Africa, what is the potential for international trade of South Africa. Finally, we will take a closer look at this course. Let me start with David Ricardo. We're indebted in several ways to David Ricardo. First, for his numerical example illustrating, and I suppose most of you have heard of that, the comparative advantage in trade between Portugal and England. Yes, it's about wine and textiles. This was presented by David Ricardo around 1850. It was one of the important ideas that changed or started international trade theory. The second was his objection to the Corn Laws. He held that tariffs on agriculture and imports would misallocate resources by bringing inferior land into cultivation and would alter the income distribution by increasing rent at the expense of squeezing wage and profit rates. This second idea is a brilliant presentation of the real impact of tariffs on international trade. Yes, so if you have a tariff on agricultural imports, then he says that we would misallocate resources because then, of course, the price level would increase and suddenly land that was not considered to be profitable, inferior land, was just brought into cultivation because after the introduction of the tariff, the price of agricultural goods increased, and so the landowners, would benefit from an increasing rent. And of course, the way he looked at things was a kind of zero-sum game, so that an increase in the rent to the landowners could only be possible at the expense of squeezing wage and profit rates in industry, in manufacturing industry. Well, if you want to go into David Ricardo's contribution to international trade theory, there is this author, Robert Demand, which wrote about David Ricardo and the history of economic ideas, a very interesting journal. Well, with these two ideas, Ricardo delivered the motivation for international trade theory, today a large body of very differentiated research. In the age of globalization, many poor countries benefited enormously from the gains from trade, while others continue to believe that wealth results exclusively from domestic production and that the division of labor is not, as Adam Smith correctly hypothesized, limited to the extent of the market. Modern research in this area deals with the characteristics and behavior of firms engaging in foreign trade, as well as with the characteristics of traded goods and services. While finished goods only account for a minor share of traded goods, intermediate goods and services play an increasing role in international trade. While Ricardo analyzed the exchange of goods between two countries and industries, we are nowadays interested in trade at the firm level, including intra-firm trade, and at the sectoral level, intra-industry trade. Finally, we're interested in global and regional value supply chains, which is tantamount to say that trade flows go hand in hand with flows of factors of production, which is why foreign direct investment and migration are often studied together with international trade. Climate change. Climate change also has an influence on international trade. Why is this so? Well, a number of countries have signed the Paris Agreement and committed themselves to reduce carbon dioxide emissions and improve their ecological footprint. Since not all countries immediately introduced measures to mitigate climate change, countries unwilling to reduce emissions are still participating in the international division of labor. As a response to leakages in the system, countries actively reducing their emissions are likely to tax imports from countries falling behind in their environmental policies. Thus, there is a new source of protectionism coming up as a penalty for free riders in the environmental area. Early birds are willing to keep their supply chains as emission-free as possible. In addition to carbon dioxide emissions, some countries and firms are screening their supply chains with respect to human rights abuses and child labor, themes addressed by civil society organizations in many countries. Well, let us now turn to the world trade forecasts. What is the impact, what has been the impact of the pandemic on world trade? Well, the pandemic started 2020 and we had an immediate impact on trade. Merchandise trade, according to the World Trade Organization's barometer, experienced a strong drop in the second quarter 2020, and starting the third quarter, we can also see a strong recovery in merchandise trade. Services trade also experienced a strong drop in the second quarter, but is recovering somewhat slower than merchandise trade. In this graph, we have the index of trade on this axis here, the WTO index, and here we have the time axis. What you see here, this dotted line, is the trend of merchandise trade in the period 2011 to 2019. So this is the long run path, right? Now, the blue line, the blue curve, tells you what happened as consequence of the pandemic. We had a very strong drop in the second quarter 2020, but as you can see here, immediately trade started to recover. What we don't know exactly is what is going to happen during the current year or afterwards. This is why we have at least three scenarios here, or four. One would be to come back, yes, to the long run trend. This would be the green dashed curve here. The other one would be to continue the blue trail, just following what we thought was going to be a strong recovery. But as you can see, it lost momentum in the first quarter 2021. It increases still, but only very slowly. And finally, of course, the downside scenario uh, that we're going to get another drop during 2021 or even 2022. So this is the impact of the pandemic, and of course, as students of economics, you know, it's not the pandemic directly; it's the reaction by of governments, yes, to the pandemic. Yes, the governments came up with lockdowns and with restrictions on transport, on passenger transport, and so on. And this is what caused the drop, the fall in trade, because it was not possible to transport any goods, and many businesses they only work if people also are able to travel. This was also not allowed. So this is a recession, yes, a trade recession as a response to what governments thought was going to be the best way to face the pandemic. Now let's have a closer look at services trade. Tourism and passenger transport suffered the greatest drop, while computer services, container shipping, air freight, and financial services continued quite well during the pandemic and are now driving the recovery. As I mentioned before, it's not as fast as the recovery in merchandise trade, but it is coming. Merchandise trade was strongly interrupted and is now recovering. Merchandise trade is being driven by automotive parts, electronic components, and raw materials. Raw materials, particularly for construction, but also for many other purposes, like the construction of electronic cars and so on. Well, the reasons for the trade reduction I just mentioned, the lockdowns and the travel restrictions. And we must add that economic activity depends on vaccine production and distribution and on the emergence of vaccine resistant strains of COVID 19. So, the more vaccine production, the higher the production of vaccine and the better the equitable distribution in the whole world, yes, the faster uh, the economy will come back to the old level of activity. Now, the World Trade Forecast uh, also gives us a long run view of what is happening in the world economy. And what we have been observing in the last decade is that services trade is coming to the front. And this is why a number of studies have concluded that the greatest potential for the future of developing nations in Africa and Asia is going to be exporting and importing services, trading services. The current position of developing countries in this area is now 0.3% of world services exports, 1.3% of tourism exports, and 0.6% of passenger travel. And most of the studies, they see clearly increases in these three areas. So total world services, and particularly tourism exports, are going to increase, and passenger travel too, because we have seen that because of the consequences of the pandemic, many of the leading airlines based in developed countries that had great problems. And since it is a service uh, which is related to wages for uh, employees, uh, then the idea is that airlines based in developing countries will have to pay lower wages, and that would be beneficial for an expansion of passenger travel. Services trade generally is expanding faster than merchandise trade. Services trade has expanded uh, relatively faster over the last decades. In developing countries, micro, small, and medium-sized firms trading in services are expanding faster than merchandise traders, and they're also exporting. Let's turn now to South Africa. South Africa has a great potential as a trading nation. In its economic history, however, the country has not always been in a position to tap this great potential. As a member of the African Continental Free Trade Area, established in 2019 by 54 member countries of the African Union, only Eritrea did not join yet, South Africa has committed itself to open its markets for firms from other African countries. This market expansion for African countries was at first delayed because of the pandemic. It was officially inaugurated in January 2021. The African Union presented an action plan on boosting intra-African trade by clearly spelling out the expectations of most countries in the region. South African foreign trade potential derives from its geographical position. Yes, two coasts, yes, Indian Ocean, Atlantic Ocean, and its endowment with production factors, labor capital, and natural resources, as we see in agriculture and mining, and its capability to innovate because of its human capital. Finally, its manufacturing industry also contributes to the potential. Regional integration generally pays for a region if and only if trade creation exceeds trade diversion, both in the static and in the dynamic sense. What does that mean? Well, these 54 African countries are now embarking on a new experiment of regional integration, and the question is can it be beneficial for each one of them and for the whole region? Well, economic theory tells us that if trade creation exceeds trade diversion, it can be beneficial. What is trade creation? Trade creation means that after creating the regional integration area, which means that among the participating countries, yes, all barriers to trade are gone. Yes, no more tariffs, no more non-tariff barriers for trade between the member countries. Then there is a great potential for creating new trade, right? And if new trade is created, then we will see more firms engaged in foreign trade in several countries, either exporting or importing. And the idea of trade creation is to define the additional trade, yes, the additional trade adding to the trade that was there at the beginning when the regional integration scheme was introduced. Now, what is trade diversion? Trade diversion is when, for example, a company in South Africa, before starting with a new regional integration scheme, was exporting some products to, let's say, a third country, to Japan. Yes. And after this regional integration scheme came into being, now instead of exporting these products to Japan, the South African firms starts to export the products to Zimbabwe, yes, or to Botswana, yes. So then what we have a change in the trade patterns, yes. Old trade, the trade between South Africa and Japan, yes, is now diverted, yes, to other places, yes. So again, from an economic point of view, the idea is that trade creation can happen and trade diversion can also happen. But only if there is more trade created than trade diverted can we speak of a benefit for the participating countries and for the region. What are the consequences of regional integration? Well, because all participating countries open the markets for firms from the partner countries, yes, the neighboring countries, you have more competition on all markets. And a higher level of competition exerts pressure on firms to become more efficient and more productive. And if a firm becomes more efficient and more productive, then of course it also becomes eligible for exporting. Because only generally those companies that have a higher level of efficiency and productivity are those that really engage in foreign trade. Why? Because if you engage in foreign trade, somebody is selecting your produce, your goods, or your services as compared to the services offered by many other companies all over the world. So that somebody has identified you, this means that you must have a minimum level of efficiency and productivity for being eligible as an exporting firm. Now, I have uploaded for the first week 5 readings related to South African trade, just to give you an idea of what is happening in the literature, what are the different opinions, what are the different results of empirical work, and what is the spectrum of research on South African trade. And let me now comment on 3 of the 5 papers uploaded. There is a National Bureau of Economic Research paper written by Lawrence Edwards and Robert Lawrence, published in 2006. They discuss the role of trade liberalization. And they conclude empirically that there is proof that South Africa has benefited a lot from a reduction of tariffs and non-tariff barriers on imports. This result shows that trade policy really matters, which is actually also the title of this paper. There is also an IMF paper on South African exports performance written 20 in 2016. The authors in this paper focus on the impact of the real exchange rate on trade. And they conclude that during the period of real exchange rate depreciation, generally when the real exchange rate depreciates, then this should act as a stimulus for exports. So that during a period of real exchange depreciation, sluggish, and I'm quoting, sluggish exports combined with relatively inelastic imports have resulted in widening the current account deficit. So generally, when the real exchange rate depreciates, you see more exports, and you see less imports. Yes, because imports become dearer, more expensive. But in the case of South Africa, imports are very inelastic. They don't react to real exchange rate depreciation. And the way exports react is also very, very slow and very sluggish, like the authors say. So they criticize the low elasticity of that African trade with respect to the real exchange rate and point at existing barriers to trade. There's an interesting paper by David Kaplan, published in Viewpoint 2019, on South African industrial policy. This author claims that industrial policy has not been successful in South Africa because vehicle exports have been growing while imports of intermediate products expanded at the expense of local content of vehicles exported. So he's saying that even an increase in vehicle exports has not benefited the country because at the same time imports have increased too, and local content has been reduced. I think, and this is my comment, that the author seems to overlook that South Africa has become a partner in regional and global supply chains, which is why both exports and imports have increased. The share of local content should move according to the industry's competitiveness and not due to policy. So if there is a very competitive supplier in some other country, why not use it? Because we can save money. Why should we pay higher price for the same components, yes, if we can buy cheaper somewhere else? The author, however, is correct about the excessive and in part misguided subsidization of the automotive industry in South Africa, and also about the competitiveness of the South African clothing and textile industry. He says this clothing and textile industry is not very competitive. Furthermore, the author looks for some solutions, and the solutions that he proposes is to establish more export processing zones or special economic zones in order to reduce barriers to trade. So, he is telling us that, well, actually, we should change the national trade policy. But to the extent that we are not able, because there are interests, lobbyists lobbying for certain barriers to trade, and if the probability, the likelihood, of changing the national trade policy is very low, then what one could do is to try to reduce barriers to trade selectively by establishing export processing zones where only the firms that are established in this zone, they have the opportunity to engage in international trade without taking care of the barriers existing in national law. Yes, the same happens with special economic zones. Those two types of zones are exempt, yes, of most of trade policy barriers. So that is his solution to the problem. South Africa already has zones that reduce barriers to trade, but he says we need some more, for example, for the automotive industry and also for the textile industry, clothing and textile industry. Very interesting to discuss these topics. Well, let me now come back to the course, just having given you a small tour d'horizon of what is happening in international trade policy right now. We have the impact of the pandemic. We have new regional integration initiatives coming up in Africa. Let me tell you something about the course. Well, the course aims at enabling students to understand trade activity and its contribution to employment, economic growth, and welfare. Enable students to analyze trade policy in developing and developed countries. Enable students to understand trade theory. Enable students to understand empirical approaches to explain trade patterns. Enable students to join research networks and access latest research work. And enable students to discuss global, regional, and national issues in international trade. As you know, there will be a lecture each week beginning today on the 19th of August. Prescribed readings will be uploaded to ICAMBA. They're already there in part. They include selected chapters taken from a textbook called Applied International Trade, second edition, published in 2012 by three authors well known as international trade researchers. In addition, there are a number of articles published in international journals, some working papers, and a few reports of international organizations. The course aims at finding the right balance between theory, empirics, and trade policy. All three areas are intertwined. Yes, empirical research depends to a great extent on practical trade policy experiments and on firm behavior for data. Yes, we need the data generated by the policy experiments, and we need the data on firms engaging in foreign trade. Moreover, empirical research also contributes to strengthen or weaken existing theories, and of course, to create new theories. That is why we need to find the right balance between these three areas: theory, empirics, and trade policy. What are the requirements for this course? Well, readings are designed to cover most of the area of the lecture. Students are recommended to scrutinize the prescribed readings in advance so they can actively participate in the lectures. The assignment has already been uploaded to ICAMBA. Please download it and prepare it for uploading again before the September deadline mentioned in the module outline. The module test would take place during the month of September. Remember to prepare all previous lectures for the test. Also, please use the discussion forum on ICAMBA in case you have content-related queries. Well, thank you very much for your attention, and we will meet again on next Thursday. Thank you very much. Bye-bye.